They told you it was over. They told you the Supreme Court decision on tariffs would crush the global economy. They told you that industrial demand would collapse. They told you to sell your metal and run for the hills. And for about 24 hours, the algorithms believed them. But if you looked at your screen this morning, you saw something very different. You didn't see a crash. You saw a roar. You saw silver smash through the $80 resistance like it wasn't even there, trading up over $3 to hit $82.71. You saw gold erase every single penny of its losses, surging $85 to reclaim the $5,000 throne at $5,092. The tariff slam was a trap. It was a noise event designed to shake the weak hands one last time before the real data came out. And today, we have the real data. We have the numbers from the biggest gold producer on the planet. And if you thought First Majestic's earnings were impressive, you need to sit down for what Newmont just released. We are watching a fundamental shift in the mining sector that changes the investment thesis for the entire world. Newmont Mining, the heavyweight champion of the gold sector, just dropped its full-year results for 2025. Wall Street was expecting good numbers. They were expecting a solid beat. But Newmont didn't just beat estimates. They crushed them by 24%. This is a company that is often criticized for being slow and bureaucratic. But in a $5,000 gold world, even a giant can sprint. Let's look at the cash. Newmont reported a record free cash flow of $7.3 billion. Let me repeat that. $7.3 billion. In the fourth quarter alone, they generated $2.8 billion in free cash. To put that in perspective, that is more free cash flow in one quarter than Amazon generated for years during its growth phase. This is not accounting profit. This is real, spendable cash that is left over after paying for all the mines, all the equipment, and all the taxes. And what are they doing with this mountain of cash? They are fixing the one thing that has held miners back for decades: debt. Newmont reduced its debt by $3.4 billion. They ended the year with a net cash position of $2.1 billion. This means the largest gold miner in the world is effectively debt-free and sitting on a pile of liquidity. They have a fortress balance sheet with $7.6 billion in cash and over $11 billion in total liquidity. Why does this matter to you as a silver stacker? Because gold leads the way. When the general of the army, Newmont, is financially invincible, it signals that the sector has entered a golden age. It signals that the price of the metal has risen far above the cost of production. Newmont reported an all-in sustaining cost of $1,358 per ounce. They are selling that gold for over $5,000. The margin is astronomical. It is nearly $4,000 of profit on every ounce they pull out of the ground. And they are sharing that wealth. They returned $3.4 billion to shareholders through dividends and buybacks. They announced a sustainable annual dividend of $1.1 billion. This is the signal that the generalist investors have been waiting for. The pension funds, the endowments, the family offices, they have ignored this sector because it was too risky and didn't pay a yield. Now, Newmont is paying a yield that beats the S&P 500, with a balance sheet that is cleaner than the U.S. Treasuries. This is how the big money rotates. They don't buy the metal first. They buy the miners who print the cash. And once that capital floodgate opens, it lifts everything. Newmont, First Majestic, and the physical metal itself. But there is a detail in the Newmont report that hints at the future supply crunch. Despite the record profits, their production guidance for 2026 is actually down. They are forecasting 5.3 million ounces, a trough year due to mine sequencing. Think about that. The price is at an all-time high. The profits are at an all-time high. And yet, the largest miner in the world cannot immediately increase production. In fact, they are producing less. This proves that the supply cliff is real. You cannot just turn a dial and get more gold or silver. It takes years to build a mine. So we have a market where demand is exploding, prices are soaring, but supply is structurally constrained. That is the definition of a supercycle. So the tariff panic was noise. The Newmont earnings are the signal. But while the miners are swimming in cash, the physical vaults are drowning in demand. While Newmont is digging it out of the ground, the COMEX is seeing it fly out the door. We have fresh data on the silver vaults that confirms the holiday raid we discussed earlier did absolutely nothing to slow down the drain. In fact, the lower prices earlier this week only accelerated it. Another 1.4 million ounces of silver vanished from the COMEX vaults today. We are watching a relentless mechanical depletion of the registered inventory. Every time the price dips, the industrial buyers step in. Every time the price rips, the momentum traders step in. The vault is getting hit from both sides. In the next part of this report, we are going to break down this vault data in detail. We are going to look at the specific withdrawals from Brinks, HSBC, and Loomis. We are going to analyze why the registered inventory dropping to 88 million ounces is a DEFCON 1 signal for the paper market. And we are going to connect this drain to the massive first notice day looming in March. The miners have the cash. The exchange has no metal. The transfer of power is happening right now. While Newmont is counting its record profits, the comex is counting its empty shelves. We have to talk about the physical drain because it is the ground zero of this entire market move. The earnings reports tell us the miners are healthy, but the vault reports tell us the exchange is critically ill. We have just received the latest daily data from the CME group regarding silver inventories, and the numbers are relentless. Another 1.4 million ounces of silver were drained from the comex vaults in a single 24-hour period. This is not a trickle, it is a flood, and it is happening across the board. Let's look at the specific warehouses because the breakdown tells us who is losing metal. Brinks saw withdrawals of 590,500 ounces. HSBC saw withdrawals of 640,600 ounces. Loomis saw adjustments out of registered inventory totaling 540,700 ounces. Even the smaller depositories like CNT and Asahi are bleeding metal. 156,000 ounces left CNT, 65,000 ounces left Asahi. Every major vault is seeing outflows, and this brings us to the most critical number on the board. The registered silver inventory, the metal that is available for immediate delivery against futures contracts, has fallen to 88,191,000 ounces. We are now officially below the psychological 90 million ounce mark. We are entering the red zone. Why does 88 million ounces matter? Because we are staring down the barrel of first notice day for the March contracts. As we discussed in previous reports, the open interest for March is massive. There are paper claims for hundreds of millions of ounces. And there are only 88 million ounces sitting in the window to satisfy them. Every single day that we see 1 million ounces leave the vault, that leverage ratio gets worse. Every ounce that leaves Loomis or HSBC is an ounce that cannot be used to settle a contract next week. The math is becoming undeniable. The holiday raid earlier this week was supposed to scare people into selling. It was supposed to bring metal back into the system, but the data proves it failed. The lower prices didn't create sellers, they created buyers. The industrial users and the arbitrage traders used the dip to accelerate their withdrawals. They thanked the paper traders for the discount and took the physical bars. And it is not just the institutional whales who are buying. We have a major signal from the retail market that confirms the public is waking up. We need to talk about the sales data from Bullion. This is one of the premier precious metals dealers in the world, based in the hub of Singapore. Their data is a proxy for global retail sentiment, and their January numbers are staggering. Bullion reported $357 million in gold and silver sales in just 1 month. That represents a 300% increase year over year, 3 times the volume of last January. This tells us that the Main Street investor is moving capital at a pace we haven't seen since the peaks of 2011. But there's a detail in the Bullion report that is even more bullish for silver specifically. Historically, retail investors buy mostly gold. In January of 2025, the sales mix was 75% gold and 25% silver. But last month, the mix shifted to 50-50. Half of the money flowing into precious metals is now going into silver. This is a massive rotation. It suggests that the public is doing the math on the gold to silver ratio. They see gold at $5,000. They see silver at $80. And they realize that silver has significantly more room to run to catch up to its historical average. When the retail public starts buying silver in equal dollar terms to gold, the physical float evaporates instantly. Remember, the silver market is tiny compared to the gold market. If you throw $350 million at gold, the market absorbs it. If you throw that same amount at silver, you clear out every refinery in Switzerland. So we have a pincer movement. On one side, we have the industrial giants draining the comex vaults to feed their factories. On the other side, we have a retail frenzy that has tripled in volume and shifted aggressively into silver. And caught in the middle is the paper exchange with only 88 million ounces left. This is why the price action today was so violent. This is why silver spiked $3 to 82.71. The market is sniffing out the shortage. The short sellers who tried to press the price down earlier this week are realizing they are trapped. They looked at the SCOTUS tariff news and thought they had a winning ticket. But the physical market didn't care about the Supreme Court. It cared about the fact that there is no metal. The tariff slam was erased in 24 hours because you cannot print silver to pay a tariff. You need the real thing. In the next part of this report, we are going to look specifically at the Newmont guidance for 2026. We mentioned earlier that their production is forecasted to dip. We need to explain why this trough year is actually the most bullish signal for the long-term price. It confirms that even with record cash flow, the mines are tapped out. We will also discuss the capital allocation framework that Newmont announced. They are prioritizing dividends and buybacks over new exploration. Why? Because it is cheaper to buy their own stock than to find new gold. This creates a permanent supply deficit that will keep a floor under prices for years to come, and we will connect this back to the first notice day countdown. With the price back above $80, the incentive to stand for delivery just increased. The shorts are running out of time and the vaults are running out of bars. And time is the one thing the shorts cannot buy. While the vaults are emptying, the clock on global production is ticking backwards. We need to talk about Newmont's forward guidance again because it reveals the terrifying reality of the supply cliff. Newmont is the gold standard of the mining industry. They have the best geologists, the deepest pockets, and the biggest mines. And yet, in a year where they made $7.3 billion in free cash, they are telling us that production will actually fall in 2026. They are forecasting attributable gold production to drop to 5.3 million ounces. This is what they call a trough year. It is due to mine sequencing, lower grades, and divestitures of non-core assets. But read between the lines. If the largest miner in the world cannot increase output when gold is over $5,000 an ounce, who can? Nobody. The entire industry has underinvested in exploration for a decade. They spent the last bear market cutting costs, high-grading their mines, and repairing their balance sheets. Now, the bull market is here, and there are no new projects ready to go. It takes 10 to 15 years to find a deposit, permit it, build it, and pour the first bar. So even if Newmont spends billions on exploration today, that gold won't hit the market until the 2030s. We are staring at a structural supply deficit that will last for years. This is why Newmont announced an enhanced capital allocation framework. Instead of chasing expensive growth, they are returning capital to shareholders. They are prioritizing sustainable dividends. They are prioritizing share buybacks. Why? Because buying back their own stock is cheaper and safer than building a new mine in a risky jurisdiction. They have $2.4 billion remaining in their share repurchase authorization. This puts a massive floor under the stock price. It reduces the share count, which increases the earnings per share, which drives the stock higher. It is a virtuous cycle for investors, but a vicious cycle for supply. The less money they spend on new mines, the less metal comes out of the ground in the future. And the less metal there is, the higher the price goes. Now, let's pivot back to silver. Newmont produced 28 million ounces of silver in 2025. That is a significant amount, but it is a byproduct. They are digging for gold, and the silver comes along for the ride. This means silver supply is inelastic. It doesn't respond to price. If silver goes to $100, Newmont isn't going to mine more gold just to get the silver. They will mine based on the gold price and the gold grade. So, the silver market is stuck. Demand is exploding from solar panels and investment, but the primary supply from byproduct mining is capped. And the primary silver miners like First Majestic are too small to fill the gap. This is the perfect recipe for a squeeze. And speaking of squeezes, we have to look at the immediate technical picture for silver. The price action today was textbook bullish. Silver broke through the final trendline resistance that had capped the rally for weeks. It spiked above $80 and held. The close at $82.71 is a breakout. It confirms that the correction from the holiday raid is over. The buyers have stepped in. The momentum has turned. And now there is very little resistance until the recent highs of $86. If we clear 86, we are looking at blue skies. The path to $100 is open, but the most important signal is not on the chart. It is in the calendar. First notice day for the March contract is fast approaching. With the price back above $80, the math for standing for delivery becomes compelling. If you are an industrial user, you look at the 88 million ounces in the vault. You look at the falling production from miners like Newmont, and you realize that if you don't take delivery now, you might not get metal later. The fear of missing out, FOMO, is shifting from the retail speculator to the industrial buyer. The industrial buyer cannot afford to be wrong. If they run out of silver, their factory stops. So they will pay any price. They will drain any vault. They will squeeze any short. In the final part of this report, we are going to look at the specific targets for next week. We are going to discuss how the retail frenzy we saw in the bullion star data could accelerate as the price breaks out. We will also look at the gold market's psychological reclaim of $5,000. 5,000 is a massive number. It is a round number. It captures headlines. When gold stays above 5,000, it brings in the generalist investor. It brings in the person who has never bought a coin in their life. And when that person buys gold, they often look at silver and say, wow, that looks cheap. This is the final leg of the bull market, the public participation phase. And based on the data we are seeing, it has just begun. Stay with us. We are going to wrap this up with a clear strategy for the week ahead. This brings us to the end game for the week. We have seen the tariff slam fail. We have seen Newmont deliver a masterclass in profitability, proving that the mining sector is now printing cash faster than almost any other industry. We have seen the silver vaults drain relentlessly, dropping to 88 million ounces. And we have seen the retail public wake up, with sales at major dealers tripling year over year. Now, as we close the books on Friday, February 20th, 2026, we have to look at the week ahead, because the setup for next week is explosive. The price action today was not just a bounce, it was a statement. Silver reclaiming $82 and gold reclaiming $5,000 changes the psychology of the market. It tells the shorts that the dip is over. It tells the industrial buyers that the window to buy cheap metal has closed. And it tells the general public that the bull market is alive and well. So here's the strategic outlook for the final week of February. The first thing to watch is the follow through. We broke resistance today, but can we hold it? If silver opens strong on Monday and pushes towards $84 or $85, it confirms the breakout. It confirms that the holiday raid was a bear trap and that the path of least resistance is higher. The key level to watch on the downside is $80. If we can stay above $80, the structure is incredibly bullish. It turns previous resistance into new support. The second thing to watch is the first notice day countdown. We are now inside the final window before the March contracts have to be settled or rolled. With the price rallying, the pressure on the shorts increases exponentially. Every dollar the price rises is a dollar more of margin they have to post. And if they are naked short, if they sold paper silver they don't have, they are staring at unlimited losses. This could trigger a short squeeze into the delivery deadline. We might see violent moves to the upside as desperate traders cover their positions at any price. If you see silver spike $3 or $4 in a single day next week, that is likely a short covering rally. The third thing to watch is the retail frenzy. The bullion star data showed a massive shift into silver. As gold holds above $5,000, the sticker shock for new investors is real. $5,000 for an ounce of gold feels expensive to the average person. But $82 for an ounce of silver, that feels affordable. That feels like a bargain. This psychology drives the gold to silver ratio lower. Currently, the ratio is around 60 to 1. Historically, in precious metals, bull markets, that ratio drops to 40 or even 30. If gold stays at 5,000 and the ratio goes to 40, silver goes to $125. That is the math. That is the potential. And the retail crowd is starting to figure it out. Finally, we have to look at the geopolitical picture. The tensions are not going away. The debt crisis is not going away. The de-dollarization trend is accelerating, as evidenced by central bank buying. Newmont's earnings confirmed that even the biggest miners cannot increase supply quickly. The supply is inelastic, the demand is rising, and the paper price is finally starting to reflect reality. The volatility next week could be extreme as the shorts fight for survival. They might try one last slam, they might try to create a panic. But as we saw this week, the dips are being bought aggressively. The buy the dip mentality has returned. We are witnessing a historic moment. The transfer of wealth from paper assets to real assets is accelerating. The miners are leading the way with record cash flows. The vaults are signaling a physical shortage. And the price is breaking out to new highs. Subscribe.